session then, what I'm trying to do is give everybody here a taste of the variation in this market. There is a lot of variation, there are loads of different ways that things can be done, but one of the most rapidly growing areas that I've seen over the last few years has been the discretionary portfolio manager, DFM, people organising panels, portfolios around this area. And what I did is asked a few of people who I know and respect and think are doing quite good and interesting and different things. So these 5 people in front of you, all different strategies, all credible, and I will be asking them a couple of questions each, and I hopefully will also allow time for questions from the floor, assuming we can crack through it within the given half an hour that we have. So, without further ado, should we start with the mic at this end? Damien, maybe, and then just pass down. Can you all hear me okay if I just talk? I know it's not as great for the recording, but my voice does tend to be loud enough. So I'll kick off maybe from this end. Damien, if you'd like to introduce yourself and say briefly who you work for and what you do in this area.
Sure. Good afternoon, everyone. I'm Damien Lardu. I work for EQ Investors. As a firm, we've been focusing on impact investing for about 10 years. And 6 years ago, we launched some model portfolios available on a number of platforms, very much focusing on impact investing with the idea that you invest in companies which core products and services are helping to make a positive impact on the society environment.
Okay. And then Amy, please.
Hi, I'm Amy Clark. I'm one of the co-founders of Tribe Impact Capital, which is an impact-only wealth management firm based in London. We will be officially two in November. We're a benefit corporation and we manage institutional and private client capital for alignment and delivery of the Sustainable Development Goals through investment strategies.
And who have we got next, Stuart? Sorry, go ahead, please.
Hello, I'm Stuart Ryan. I work for Rainer Spencer Mills Research, which we're known for our ratings. I look after the SRI ratings at RSMR, but recently, earlier this year, we launched a set of DFM models, 3 of which are SRI rated, or SRI portfolios, and the remainder use sustainability as a thread running through them.
Hi, I'm Charles Younes. I'm working for Financial Express, FE. As you might know, FE for the TrustNet website, also for analytics. We launched our research proposition 6 years ago. We've been selecting sustainable funds for now 6 years. And in January last year, we launched our risk-targeted model portfolio using only sustainable funds, and we're now managing 20 million on those portfolios.
I'm Kate Elliott. I'm part of the ethical research and engagement team at Rathbone Greenbank Investments. Greenbank is the specialist ethical and sustainable investment division within Rathbone Investment Management. We specialise in discretionary portfolio management on behalf of private clients, individuals and charities. And all the portfolios that we manage will integrate ethical and sustainable investment considerations, and it's the job of me and my team to assess potential investments from the environmental social point of view and make sure that they align with our clients' objectives.
Right, maybe I could ask, maybe Katie, you want to hang on to the mic and we'll pass it back down, going the other way now maybe. Can we just touch on how you look at the SRI and ESG side and impact, and basically what things you look for, what you like, what you look for in a company, what you dislike, what you avoid. Just talk maybe for a couple of minutes on the strategy and kind of an outline of what you offer on that side.
So when we're looking at collectives, I should say, so our portfolios will be a blend of kind of direct investment in equity and fixed income, and also the use of ethically screened or sustainable focused collectives. And there's really 3 things that I look for when we're assessing collectives from the sustainability point of view. Firstly, we would look at what their policy is, whether that be if they're an ethically screened fund, what are the areas that they would be screening out or positively investing in, or if it's a more sustainability themed fund, what is the kind of scope of the positive area that they would be investing in. And that policy really just gives us the kind of, it's the initial getting an idea of the risk of there being investments within that fund that we wouldn't expect to see. So that's the kind of first thing that we would look at. I think it's also really important to get an idea of the experience and understanding of the fund management team. And this kind of comes back to some of the points that Julia made earlier about the dangers of greenwash. So it's all very well that a fund might have an excellent policy there, but you need to be sure that it's being implemented in the way that you would expect. So we want to make sure that the fund management team really understand the issues, are looking at the underlying investments in the same way that we would. And that's particularly important when you've got issues that are perhaps a little bit less black and white. So if you're looking at things like human rights performance, there is a degree of qualitative assessment in there, and we want to ensure that any screens that are kind of stated to be applied to the fund are actually being implemented in a really robust manner. And then the third thing that we would look at would be, of course, the underlying holdings in the fund. And you can do a kind of quick and easy check. So the top 10 holdings are readily available. So you can that will give you an idea of an initial sense check of how well the sustainability or ethical objectives of the fund are actually being implemented in practice. We think it's actually important to periodically look through the full list of holdings as well. I've not actually seen it myself, but I've heard stories of funds that will kind of deliberately keep potentially controversial holdings outside of the top 10. Luckily, we've not seen that in any of the ones that we look at, but I think it's important just to do that kind of degree of due diligence and make sure that kind of what has been promised is actually what is being delivered.
Regarding Financial Express, how we select sustainable funds, so it all starts from exactly the same investment universe and non-sustainable funds. We look at the financial performance of the funds using our different set of ratings, such as the FE Crown rating or the FE Alpha Manager rating. And the ethical aspect of the investment is happening when we meet with fund managers. And yes, obviously you can measure the carbon footprint of the fund. You can look at the underlying holdings because we have access to the full portfolio holdings. But we are more interested in the consistency of the approach being taken by the fund manager. How is this interest aligned with the sustainable or with clients with a sustainable approach to their money? How often do they interact with their clients, with their unit holders? Because it happened that some funds have never changed their negative screening pretty much for the last 10, 20 years. Well, as you could see this afternoon, like the definition of sustainability has changed over time. So that's a key element when we meet with fund managers. And then, so yes, we make an assessment, and then we don't have a preference in terms of strategy. So a lot of people now have moved from the negative screening to just a positive screening to how fund manager interact and engage with corporate. We don't have a preference in terms of strategies. Once again, about how consistent has been the fund managers in his approach to ethical investment.
So at RSMR, the same approach applies to the SRI ratings as to any active ratings. So we start with a quant screen on an IA sector. So we look at global equity, or maybe UK equity income, for example. And within that, we compare off the quant numbers. From there, it will be whether decided within our research team whether we wish to take this to the next stage, which will be a comprehensive RFP document. That is then filled in. And for SRI funds, for sustainability, ethical, or thematic funds, there are extra questions that are included in there. That is then sent off. If that's completed and it's completed to the sort of level we expect, then we engage and have one-to-one meetings with the manager, which then gets us the kind of whites of their eyes test to see if they actually believe what they're saying. See that they're actually committed to this space, that it's not just, like Julia pointed out earlier, greenwashing. And it's not a case, it's a fad, a marketing cycle, and then it's just going to be forgotten in 3 or 4 years' time. Once we have that, we can then decide whether we want to include it in our DFM models or in our advisory models. And as a team, we have different preferences, but with the DFM models, there's a sustainability thread that feeds through because that's where we feel the growth opportunities lie.
So I'm going to be really reductive and basically say we look for well-run companies that are solving global challenges. It's as simple as that. And for us, looking at what the global challenges are, we use the Sustainable Development Goals. So whilst the SDGs, as they're called, or the global goals, colloquially, have only been around since 2016, January 2016, when they were adopted, sustainable development, as Julia so wonderfully pointed out earlier, as a term has been around since 1987. So these goals aren't new. We know what these big challenges are that we're facing. And for us, the growth, the businesses that are likely to be in growth are the businesses that recognize these challenges that we face and are going to address them. So we will look, for example, at strategies like ESG as part of the solution, and that will be potentially used as a proxy for how well run a business is. But we're also then going to look at what the business ultimately is doing, its products and its services. So we like to take a 360-degree view of a business, plus its ability to influence, and then say, okay, using that SDG framework, the 17 goals, where does that business materially align? And we have a three-pronged approach that we look at from an impact point of view, which is called our AMI framework, which is additionality, materiality, and intentionality. And we use those three key terms both across the operations and the products and the services, so that at any one time we can really understand whether the business is additional in its ability to tackle gender equality, or its ability to reduce the growing levels of financial inequality, tackle climate change. We look at how additional that company is. If you took that company out, would it have a significant effect on our ability to create the change that we need to see? We then look at materiality as well. How much of that business is aligned to how much of the issues that we now know that we face? And then we look at intentionality as well. Embedded within intentionality is a whole range of issues around reputation, around unintended consequences, etc. But this AMI framework that we've developed enables us really to quite simply look for well-run businesses tackling the big issues of the day.
So sorry, I'm the last one, so probably you're getting bored a bit. So on our side, so when we started in 2012 running a model portfolios, before we did that, as a firm we got involved in impact investing. So we helped set up a microfinance institution in Sierra Leone. Then we launched a private equity fund with the investing in unlisted company or organizations, to really make a positive impact on our society environment. And what we realized, the feedback we were getting from private clients is that, private equity is well, but this is just for a very few portion of the population. And they really wanted to make, good with their money. But what was available on the market was, primarily sort of negatively screened funds. So we decided actually to take, exactly the opposite view and align that with, what the clients really wanted is, investing into companies which are, solving social and environmental problems which we all familiar with. This is how we started. And so we looked at, the whole universe, and we found, a few fund managers, a few of them which are around today, which, mindset is very much aligned with ours, which is, to make that positive impact. So this is how we started in 2012, and it's been a journey for us. So I don't want to repeat too much on what Amy just said, but in terms of what we're looking for in the fund manager, the first thing we do, before even, being in contact with any fund manager, is just looking at the full list of holdings. And very quickly, you really know whether or not the companies chosen are really there to make a positive impact on society and environment. And what really we're looking for, and we're looking at very closely, is the core products and services. So does that company, its purpose, is really to make that positive impact, to help tackle all the challenges that we're familiar with. So that's, I would really encourage you to look at the full list of holdings. And so that's one thing. Then we want to make sure then when we meet with the fund manager that the stocks which are chosen are very much aligned with that sort of intentionality to make a positive impact. Then this additionality element is very interesting because you want to support companies which are making an impact now, which if they were not there, we would still facing those issues. But what's really important to us, and I really want to stress that, is we want this impact to be able to be measured. And that's really important because what we're finding, a lot of private clients, they say, okay, you're telling me my money is doing good, but how can I believe you? How can you prove it? So there's different ways you can do it. you can, map your portfolios to the United Nations Sustainable Development Goals. So just, to give you an idea of the big themes that, the clients are getting invested in. That's one way of doing it. But what we really believed is that, the client is saying, but what does that matter to me, to the 50,000 pounds I've put in my ISA? And this is what we're doing in our impact reporting, which we do once a year, and we make available to financial advisors and their clients, is that they can calculate exactly how much impact they've achieved, looking at, for example, the amount of renewable energy being generated, looking at the number of patients they've been helped to treat. So that's what we really want to do, is to really help clients to be convinced that their money is really aligned with their values. There are some people who really, when they, obviously through their financial advisors, when they talk to us, it's very much that, they want to make that positive impact and they want the whole portfolio to make that impact. But a lot of people, they still a concept which is new to them. So what a lot of people are doing, they might do, their ISA allowance, or they might do, the GIA and keep maybe the big pension still in the more mainstream type of DFM solution. And as they get comfortable with the fact that they don't have to compromise on financial return, and actually, if anything, we've proven that actually you can even outperform, then this is when they keep adding, particularly when you tell them the story, how they're making that positive impact. So a bit of both.
And Katie, you know us. Obviously, we've been set up to only do this. So the clients that we have, the capital that we have under management, 100% of it is managed according to the Sustainable Development Goals and our ability to deliver them. We have some clients who have 100% of their wealth with us. We have other clients who might have, to your point, Katie, a little bit of a toe in the water to see, what this is all about, to, dispel some of the myths around sacrificing financial performance as well, which still lurk in the city. A couple of stats and facts for you, actually picking up on something that Simon was talking about earlier in Good Money Week, focusing on women. 50% of our clients are female. The average age of our client base is 45. The average age of the wealth management industry client base in London, I think, is roughly speaking in the 70s. So we are attracting, it's a very democratic tent that we've created at Tribe, but we're attracting the segments that Damien and the others here will know are really beginning to get interested in this space. And whilst you have some of the youngsters who might come on board and say 100% of my wealth straight off the bat is going to be impact-led or impact-driven, there'll be others who will sort of dip their toe in the water to start with. But it's, as I'm sure as we'll all agree, once you're in, it's actually very difficult in a really positive way to get out, because it's quite addictive. When you know that you can do well and do good, you just want to do more of it. And that's certainly what we find with our clients.
From the RSMR perspective, we're one step removed, really, because we're dealing with IFAs directly. But I can comment from my previous role managing money in London, where I did have clients. So when I was managing money back in, say, 10 years ago, you'd get some people to be, well, I'd like my ISA to be SRI, but I want my SIP to be conventional. And conventional is like term I'm not too happy with the use of, because I feel that this is conventional, this is common sense investing. But when you go through the actual performance numbers and the actual stories in the portfolio, you'd say, well, I'd like someone with that in my SIP, or actually I want to go 100%. And even now with the RSMR models, we use the sustainability exposure because it delivers alpha. It's there, it's delivering performance and diversification benefits. And when you can show that to clients, they're really taken by it.
Yeah, obviously at FE we work with a lot of financial advisors across the country, and they've seen a rising demand, especially from young people, to manage their money. And like it was said before, with millennials and with these young clients, it is 100% or nothing. And after a financial advisor, typically they don't have a preference for negative or positive strategy. They leave this decision to us. But they want 100% of the money being managed with that sustainable approach.
And I just echo the points of the other speakers that I don't think that there is kind of one single type of client or ethical investor. I think definitely across our client base we will have those who are more focused on impact and positive returns, and those that take a kind of slightly more traditional approach and it's more about exclusions. But what we are seeing is that while there is growing interest in the positive investment space, people don't want us to lose sight of those kind of avoidance diligence criteria. People want to be sure that 100% of their portfolio is kind of avoiding harm. And I think we do need to remember that every investment has an impact, be it negative or positive. So it's just important that when you're kind of chasing those positive impact investing, that you're not losing sight of the potential negative impacts with them.
So the audience here is financial advisors, and their end clients are private clients, and the private equity market is not really what they can do. Maybe they could do it at the margin, maybe a small portion of their portfolios, but when it comes to their SIP or their ISAs, it has to be liquid assets. So it has to be publicly listed equities or listed bonds. So it's fair to say that the impact you can achieve on the unlisted market can be much higher. But if you just think about the 17 goals that you've heard today during the presentations, we need about $5 to $7 trillion a year to be invested toward those goals if we want to achieve them by 2030. $5 to $7 trillion a year. We're never going to get there if it's only the private equity market which is helping towards those goals.
And I just add on to that as well, because I think almost embedded in that question, not from you, I hasten to add, but there is an embedded narrative in that question as to whether or not you get more impact in private markets than you do in public markets. There are different types of impact, and that's one thing that we as an industry have to get very, very comfortable with, that, as Katie said, that every single investment has an impact. There's a positive element to a business and a negative element, and you're looking at that balance, and hopefully, if you're doing your jobs well, and we're doing our jobs well, we're looking for those net positive businesses, recognizing the negative externalities that will be embedded within that. We don't struggle to create, I would say, balanced and diversified portfolios for our private clients, recognising what Damien's just said, obviously, about the financial advisor community across public and private markets, recognising that we are client-led. So every single client will have a bespoke portfolio, and that portfolio will be reflective of not just their financial behaviours and tolerances, but their values. And that's the really important thing, is that we will lead the conversations with our clients based on their values, what they care about, why they care about it, and how that manifests in terms of the change that they want to see in the world. We then bring the financial elements on, as part of that conversation. So we get a very, very, I would say, multi-dimensional view of our clients. That will then dictate what type of impact they're looking for, what type of thematic area they might be interested in, if it's poverty eradication, if it's food security. And that will then inform the type of portfolio that's put in place. But as Damien's rightly said, in the financial advisory community, it's a little different.
Yeah, I'd agree with Julia. I mean, when we look at portfolios or funds, the costs are the de minimis really across the spectrum. I mean, obviously there are funds that are more expensive, but that happens across, if you want to call it conventional as well as SRI. So it's just understanding the man. It might be a small manager who's starting out a boutique where they have to outsource a lot of their functions, so that might play into the cost. But the cost element, I think that's a bit of a red herring, if you want to call it that. Okay. Well, part of being a ratings agency, our due diligence is meant to be we're selecting the best funds that are available. So obviously there's thousands of funds in the UK universe or the IA sectors. Our job is to be able to get nuts and bolts and get the best available, and then combine those to build a portfolio for the end client. It also frees up the IFA to be spending their time in front of their clients and actually writing business instead of worrying about, have I done enough research here, have I done enough research there, meeting fund manager. That's our job. That's what we spend all our weeks and days doing, going and meeting them, seeing the whites of their eyes, And it's building up the points that have been made about looking under the bonnet, looking at the full accounts, the interims, to make sure that there's nothing sneaked in. A few years ago, I won't name names, but there was an ethical fund that was holding mining companies. And you just think, well, where's that come from? Yeah, exactly. But then you engage on it and ask the question, well, why are you doing this? So is this in the spirit of what you're meant to be doing? So that's part of our job, is the ongoing due diligence. So you can either hire that in or you can outsource it, and that's our job, to be that kind of outsource.
Can I ask if there's maybe one last question? Sorry, gentleman here.
Do you have any involvement with the alternative investment market? Does anybody have an ethical portfolio using just the alternative investment market?
Anyone investing in AIM stocks?
So we have alternatives that factor into our portfolios, but we don't have an alternative-only portfolio. But we actively look at alternatives because there are some very, very interesting opportunities out there in the alternatives space. Whether we would ever move to create a portfolio that only focused on the alternative markets remains to be seen, but we're a great believer in the alternatives obviously as a diversification mechanism, and also where you can hold collectives and otherwise sometimes that are often uncorrelated to the main markets, which, as we all know, is kind of the holy grail.
Yeah. So if I may just add, alternatives, I think there's several definitions. What we really believe, is making an impact is, for example, infrastructure. Building infrastructure. So you've got some funds and you've got some investment trusts which are doing that. What we're not doing is buying an absolute return type of funds. That's it doesn't really, just the concept of shorting, for example, how is that really helping the society?
Okay, thank you. I think we're going to have to cut off there in the interest of staying more or less to time. If we could thank the panel in the usual way.